The mid-cap index is up about 600. That's about 1.25% higher. The small-cap index will come up on your screens, and it'll give you a sense of how we are starting there. 1.2 higher as well. Look at this. I mean, about 100, less than 100 stocks are lower. 1,800 stocks are higher. So the skew is absolutely clear which way things are. Heat map, I reckon all 50 should be in the green, and they are. Everything is up. So Tata Motors, HDFC Bank, Bajaj Finance, and so on and so forth. But all 50 up and about for now. Surabhi.
And Tata Motors is in pole position, 4% on that stock. And look at this whole reprieve on autos where he's saying, okay, I'm thinking of giving the auto guys some more time. That seems to be playing out not just on the ancillary names like Motherson and Sona BLW, but on Tamo itself. Remember, Tata Motors had announced that it is halting all shipments to the US. So investors would want to see if there's any rethink on that strategy. Maybe they'll want to ship more and more cars till the final tariffs on auto kick in. But that's a winning stock this morning. HDFC Bank is the other one. Big move, 3% on the higher side. There's M&M, there's L&T, there's Bharti Airtel. Everything is up and about. Reliance, ICICI Bank contributing about 2 to 2.5% each. Actually, autos even beyond Tata Motors are doing pretty okay. Maruti is up about 2% as we speak. M&M is up about 3%. So autos is a good-looking space. On the downside, no negative stocks on the Nifty, but relatively speaking, consumption is taking a backseat. These stocks had a good couple of days. Today, they're on the lower side of the screen. So Nestle, HUL, Asian Paints, ITC, Titan, all of these stocks are clocking the lowest amount of gain on the Nifty right now. But yes, auto stocks definitely surging higher. Look at Bharat Forge, 5%. Look at Samvardhana and, of course, Sona BLW, as Sur also pointed out. So autos and auto ancillaries in top gear this morning.
Well, that's right, Surbhi. And just to make a couple of more points, Nifty Bank, it's open at its highest levels we've seen since the 18th of December. So good going on that one. The Nifty Bank is the one that's trading way above all technical levels, and that's boosting away. It's up close to around 1,000 points. Macrotech developers, the Lodha brothers bearing the hatchet out there. The street likes it. That stock is up close to around 3% as we speak. So big up move is what we're seeing on that one. A few more names. Intellect Design, that stock is up close to around 4%. So big up move is what we're seeing out there. DLF is up close to 3%. JSPL has bounced back well. That's up close to around 2.5%. Remember, the stock was under pressure post those tariff announcements from the management. But that one as well is flying away in today's trading session. Havells is a little bit lower, actually. A very, very small, minority stake is what they've taken in the company, for around 600 crores. I think that's close to around, 25% of the cash they had in their books. If I'm not mistaken, it was 2,500 crores. Street doesn't seem to be liking it, though it's very, very small in the scheme of things. That stock is down 1.5%.
All right, absolutely. You've got, and volumes will pick up, absolutely. I'm just looking at the big volume-led gains right now. It's all, dominated, of course, by autos. So the Motherson, Tata Motors, Sona Comstar, Bharat Forge. This is, the top 4-5 volume-led gains right now. Coming through at this point in time. PG Electroplast, I think we did mention it, 5.5 higher. There's Goldium International, which was a limit up on Friday, and I think it's up another 5%, 7.5% now, Goldium. Of course, the price damage was severe. From almost 600 rupees, the stock had fallen to about 250, from 250 to 350 now, in about 3 or 4 trading sessions. So that is Goldium for you. And there's Bharti Hexacom, which is up about 4.5%, 5% as well. So that's it. There's nothing very much on the downside at all. I can spot Gravita India, which is down 1% on some volumes, but it's not meaningful. It's largely all up and about at this stage. Gautam Shah is with us. Let's talk about price action and where we go from here. Founder at Goldilocks Global Research. Gautam, good morning. Great to have you with us here. Prashant, this side. Just really one for the history books. What we've gone through over the last 6-7 days would rank right up there, especially as a trader, Gautam. So much volatility and so much excitement, so much drama. But what from here now, Gautam? Do you believe the worst is behind? We're at about 300 right now.
Good morning, Prashant. Well, drama is part and parcel of today's stock market, I think, because we live in such a noisy world where there is so much happening. I think since the COVID lows, we've had so many events, whether it's geopolitics or earnings or, the Trump trade that has played out in the last 1.5 months. But I think markets need to discount all of that very quickly, which is what markets have done. I think every bear market has two phases. One is that of price correction and the other is that of time correction. I think we ended the price correction last Monday at levels of 21,800 because I think the technical studies, the breadth, the sentiment, the news flow, everything came together to possibly indicate that it was a panic bottom. Thereafter, we've seen very good constructive action. I think the Nifty is up about 1,200, 1,300 points in no time. And I think we've entered a period of time correction. I think a lot of money which was on the sidelines is now at work because I think participants believe that most of the negatives are discounted. So that's the reason you are seeing this very good looking flamboyant rally. But I would not read too much into it. I think 23,400 and 23,800 are numbers to which the Nifty can move to. And broadly over the next 2.5 months, I think we are going to stay in a sort of a range. We will not make significant we will not see significant upside or significant downside. But between now and the end of the year, I think it's going to be a stock pickers market. Just be in the right stocks, in the right sectors, and in the right themes. I think there is money to be made on the long side. So I do believe that the worst was over at the recent low because I believe that the charts are well placed on the weekly and on the monthly time frame. And I think a large part of the news flow has already got discounted. I guess it can't get worse than this.
Sounds good. Sounds good. Gautam, can you just repeat the Nifty targets for us? So by December 25, where do you see the index?
Well, Surabhi, it's not about the index. I think let me just reiterate that because I feel that it's going to be a stock pickers market between now and the rest of the year. But still, if you want numbers, I think 23,800 to 24,000 is where we can move to in the near term. Can we go beyond that? We can definitely go beyond that and see much significantly higher levels. But I would like to cross the bridge when it comes. I want to work with a bullish mindset. I want to buy the dip now because in the last 6 months, it's been a case of lower tops and lower bottoms. I think over the next 6 months, it's going to be a case of higher tops and higher bottoms.
All right, Gautam, you mentioned numerous times out there, it's going to be a stock pickers market. What's looking good on the charts? Give us a few stocks.
Well, anything that has relative strength and anything that did not make new lows last week is something which is on top of our list in terms of longs. And I think on top of that list is financial services. I mean, if you look at the Bank Nifty, today it is at levels of 52,000, which I think is an important resistance. And once this is taken out, I think it might be the first index after financial services to actually make new lifetime highs. So I remain bullish on the Bank Nifty, and I think there are immense opportunities. And the way some of the top banks handled the recent weakness itself was quite commendable. I think I spoke about it in our last interaction as well. So we are very positive on the entire financial services space. I think it will go on to make a new lifetime highs, followed by the entire PSU basket. You know, I'm actually refraining myself from staying away from any company or stock that has something to do with foreign soil. Because in today's world, you don't know, what can come out of where. Even though the markets are all good today and autos are doing well, I'm still very comfortable with the PSU as a basket, valuations-wise, chart-wise, ownership-wise, and I think it could be one of the standout performers for the rest of the year. And finally, I think metals. It's been my favorite for a while now. Yes, it saw a bit of a dip after the market weakness, but I think it's setting up really well right now, and I think a 10 to 12% move on metals looks quite likely.
Okay, those are some very interesting ideas and observations, Gautam. So you're saying PSUs are still looking good to you, chart structures are still positive, metals 10 to 12%. And can you dive a little deeper in financials? I mean, is everything looking good? Is it more banks? Is it private PSU, large NBFCs? I mean, what within financials looks the strongest?
Well, gone are the days where you could buy into anything and everything. I think we had that phase for about 2.5 years where you bought anything and you made money. I think with this correction of the last 6 months, the men have been separated from the boys. And if you really see, top quality has stood out. I mean, a case in point being what HDFC and ICICI have done versus an IndusInd Bank and maybe some of the other smaller banks in the market. So I'm staying with the industry leaders and challengers, the big boys in each of the sectors. I know the screen looks great today and everybody will suddenly become very optimistic. But I think let's have a realistic view on the markets. And therefore, I want to stick to the big names. So the top 3 banks, the top 2 NBFCs, I think they stand out for me and I think they'll do very well.
Top 2 banks and top 3 NBFCs. So you'll stick to the larger names within banks and non-banks. Just a word, since we're talking financials, what about these capital market stocks? I mean, they were also the poster boys and poster girls of the rally up until September, right? Brokers, wealth managers, etc. What do the charts say here now?
Well, I do believe that equity markets are not running away anymore, which means that it's going to be a huge challenge for the Nifty to go out there and make new lifetime highs. I do believe it will happen, sometime over the next 12 months, but I'm not preparing myself for the same. In that kind of a range-bound environment, I'm not very comfortable with the capital market stocks. I think capital market, defense, railway were themes that did very well in the last 2.5 years. I think that the newer themes have emerged in the last 6 months, which you would have noticed, and that's the reason I'm sticking to some of the other names. On the other hand, I think real estate is one sector which can really come back very strongly. I think it witnessed a large dip. It's a structural story. A lot of stocks are at long-term supports, and the top 4 or 5 names in the real estate space have the potential to deliver about 20 to 25% from here. So I would be very comfortable buying into real estate at these prices.
Okay. All right. Gautam, you mentioned about the financials and the Nifty Bank. What are the levels we should track out there? The Nifty Bank now is holding about 52,000 mark. The last time we saw this level was on 18th of December. At around 52,500 is what we saw on that day. Where is it headed?
Nigel, the interesting data is the average decline on the whole of NSE in every single stock is about 42%. That's the kind of bear market that we've witnessed in the last 6 months. In the earlier times, this could have happened over the last it could have happened over 1.5 years. So I'm sure there's another camp of people who believe that this is going to stay for the next 6 to 12 months. But I think what could have happened over 1.5 years has happened in 6 months. I think that's one key point. Secondly, I think the way HDFC Bank has held out in this terrible looking bear market of the last 6 months is quite commendable. And this is where smart money seems to be hiding. So I do believe that some of these top stocks will do well, and therefore the Bank Nifty can easily move towards a level of 55,000. And if you have to think 18 to 24 months, I think a 60,000 number, which we have been working for almost 12 to 15 months, it remains on track. So I think as investors, you should be positioned for that number.
Okay. All right. Got that. So the Nifty Bank is the one that's revving up the engine. HDFC Bank relatively underperformed when the markets were going all guns blazing. And when the markets dipped, actually, it was holding its own. And that was the pocket to hide in, as Gautam mentioned. Gautam, let's shift focus a little bit away from equities for just a bit. How is gold looking on the charts? Where is that one headed? Because all that glitters is gold. Just take a look at the way that one has moved.
Yeah, it's been quite a glitter, Nigel. And I think every single time I've been on your channel in the last couple of years, I've spoken about gold beating the Nifty benchmark returns. And I think that's played out so far. And I think it's going to play out over the next 6 to 12 months as well. Because I don't see more than 10% upside on the index, even now, despite today's good-looking rally. But in that context, I think gold continues to be very strong. It is at our medium-term target of 30 to 50. It's looking slightly toppish here. And I think the market might just get into risk-on mode. So gold and silver could take a bit of a backseat in the near term. But if you have to take a 12 to 15-month view, I think we are still looking at lofty targets of as high as 37, 3,800. But near term, I don't think today's prices is an opportunity. I think a 5% dip could come by. And if that comes by, I think go long. And as investors, you stay put. You don't try to trade gold because it's a mega trend. It will do well. On the other hand, I think silver is a bigger opportunity. I think that is likely to stand out over the next 1 year. And not to forget what NYMEX crude has done. After almost 2 years of range-bound activity, it's broken 65. Looks like there is another 10% downside coming on NYMEX crude. And talking about external factors, dollar index at 100 at levels of 100, I think another 3-4 percentage points downside is likely there.
And that is on the dollar index?
Yes, please.
On the dollar index, 3-4% down. So dollar index, we're looking at a level of 96, 97 odd. On crude, if I got that correctly, that could be another 10% downtick even from here. And silver could outperform gold. What are the levels on silver, Gautam? Because, silver has been holding in this vicinity of around, I think, 29 to around 34 or thereabouts. It's been very volatile, but we have seen in the past, when silver gets its act together, it outperforms gold. So where is that one headed?
Absolutely. I think silver took a bit of a backseat given all the problems around economics and inflation and recession and, all the talks around it. Maybe that's the reason it's not done as well. But I think 29.30 is a nice long-term support for silver in dollar terms. And I think if all goes as per plan, I'm looking at a number of about $43 to $45 over the next 12 to 15 months. So that's a nice 30% move even from these levels. So if you're taking some profits in gold, might be a good time to top up in silver.
Okay, so book profits in gold, buy some silver. That's helpful advice. But Gautam, what about the mothership, the mother market? I mean, look at what's happened, right? I mean, what drama over the last 2-3 weeks. So given the violent nature of the US market correction, but then the recovery has been equally dramatic. So are chart structures kind of damaged? Are they okay? Are they looking okay? And then definitely a word on the US 10-year, because that's where there was sudden panic. The yield hit 4.5%. Is the worst over, or is there some slightly longer term damage here?
Well, it's violence everywhere, Surabhi, whether it's our movies or whether it's the stock markets. I think that's the way of life today. And I think markets are just too fast because of this flow of information and AI and social media. And I'm not surprised that this is the kind of world that we live in. I do believe that the Dow found a bottom at that level of 37,000. 45,000 became 37,000. 37,000 is a long-term support. If you go back in history, 2021, 22, 23, you will realize that around 37,000, there was a lot of support. And I think there are some positive divergences that have developed on the charts. And when I see some of the top names, Apple and Amazon and Alphabets and some of these stocks, I do believe that the worst for the time being is over for the US markets. So I think we are entering into a phase of extreme noise to some stability. And that's the reason even the US markets are likely to go through some time correction. In fact, as we speak, in a week from now, we are actually launching our US product because we believe that there are immense opportunities in the US markets, even from current levels after the recent damage. So I would be constructive on global equities in general, led by the US markets.
Violence in movies. What is the...
we're used to, but the stock market violence was unnerving.
What is the last 7 days of the market? What movie does it resemble? I mean, I don't know what the last action movie we've had.
Not that I saw all of
I didn't see Sikandar, so I missed it.
What about Godfather? Make an offer you can't refuse.
Yeah.
All right, I think we'll wrap it up here. Thank you very much, Gautam. Appreciate. I don't know if you have a movie which you want to put out, what it looks like, but maybe. Sorry, go on.
Well, I just saw the Sunny Deol one over the weekend, and that's where the violence part came from.
Which one?
Which one is this? I don't know.
This is Jat of Sunny Deol.
Jat. Oh, lovely. Okay. All right. Thank you very much for that. Appreciate your time here, Gautam. And we will, of course, speak again soon enough. I think, guys, we have the manager of Federal Bank ready with us.
Yes, we do have the Federal Bank management to talk about some of the important policy announcements that came in the last MPC meeting. The RBI last week published a draft regulatory framework for lending against gold. It is proposing 75% LTV ratio along with tighter valuation and purity norms as well as and also more audits. The RBI has also floated a draft paper to expand the scope of co-lending arrangements to all regulated entities. So two separate regulatory sort of paradigms playing out here. To talk about this, we have with us Mr. S. Harsh Dugar, ED of Federal Bank. Mr. Dugar, thanks very much for being with us this morning. So we just wanted to understand what each of these developments could respectively mean for the sector. Let's actually start with co-lending, which is now being made a lot wider. It's not just priority sector, it's being expanded to all sectors and all regulated entities, banks and NBFCs. So from a business standpoint, who stands to gain here? Small banks, smaller NBFCs? I mean, how does it work out?
So good morning and thank you. Yes, the draft guidelines, when you look at it, there has been a couple of changes and that actually will work good for the sector as a whole. If I have to just enumerate what are the changes which will be actually quite beneficial for the sector, the first one, as you rightly mentioned, it includes all asset classes earlier compared to what the focus was on priority sector assets. Second, they have included many more regulated entities, which was not the case earlier. Apart from that, there are three other cases which they have brought in. The minimum retention ratio is no longer there. So you can technically have a co-lending model where there is co-lending together, or it can also be for sourcing and servicing as well. So that actually widens the scope. Other two things which has come up is the default loss guarantee, which was not there earlier, which begins more skin in the game. That DLG of 5% is also going to help both the parties in terms of catering to the segment. And the last of all, which is the CLM2, at this point of time, and what it appears from the draft guidelines, that the CLM2 will not be available as an option, which was there earlier. So these are the five major differences which is there. But if you look at it from the entire perspective, I think is going to be significantly beneficial in terms of reaching out to the deeper geographies, to those borrowers who are less served by the formal banking system, by the NBFCs and banks coming together. So I think this is going to be a move in the right direction.
Do you see this having any meaningful impact, even if it is, a couple of basis points, on overall credit growth? I mean, the last year we were kind of stuck in that zone of around 10-11% system-wide credit. If co-lending takes off in a much wider and deeper manner, given these draft norms, what impact does it have on total credit offtake?
It will have a not a very significant impact because it's still in the initial stages, so it will take some time for credit offtake to pick up if I have to look at the CLM model alone. However, the good part which I have to understand over here is that the deeper geographies, which can be catered by the two kind of lenders who have presence the deeper geographies and people who have deep lending pockets, can actually benefit the borrower as a whole. So that is one significant part. It can bring down the costs for both the parties because it will be a shared arrangement. So from that perspective, it's quite beneficial for the system as a whole.
All right. Hi, Mr. Dugar. Good to see you, and thanks a lot for speaking to us here on CNBC-TV18. I want to ask you about RBI putting the draft paper on gold loans for NBFCs. Now, this provides an opportunity for banks. For you, I think it's close to around early teens, if I'm not mistaken, as a percentage of your total book is towards gold loans. Could you tell us what is the current exposure? And if you see this as an opportunity, will you think of scaling up this business?
Yeah, first of all, let me clarify. There's been a lot of chatter going on regarding that this will impact the banks less compared to NBFCs. So this is, if you look at it from a bank's perspective, it's actually quite beneficial. First, to answer to your question, we have a portfolio of about 30,000 crores plus. It ranges between 12 to 13% of our total lending portfolio is actually gold, and we are the largest private sector player in this segment. And we take pride in saying that we do understand the segment reasonably well. So that is one part of it. Coming to the other part about the draft guidelines, there are two major things which has come up. The draft guidelines seeks to do three major things. One, it has simplified the overall. There were 32 circulars, which is kind of been clubbed into one single draft guideline as it comes out. So it will make things simpler. There's no cross-referencing. There'll be no interpretation issues. So that's one part. The second part, what they have done is they have standardized it. The auction process, the notice period, valuation process, notice to be given, return of jewelry. This is actually good for the sector as a whole because from the customer's point of view, and please understand that at this point in time, the customer is the ones who does not have access to formal finance, and that's why they typically resort to gold loans, most of it, if you ask me. So it's also essential that their interests are taken care of. There's adequate customer protection, there's transparency, which is what it brings about by making the rules more standardized. That's the second one. The third and the most important one is the harmonization across regulated entities. So you have banks, you have NBFCs, you have other lenders. Over here, it has harmonized the rules and regulations. So there's no regulatory arbitrage or a play between different set of guidelines for different regulated entities. So this is going to be extremely beneficial. So now coming to the 2 points which I was talking about as to why it will benefit the banks. The first part is that it's a question of comparative, not absolute advantage or disadvantage, but comparative advantage or disadvantage. So banks were in any case following many of these guidelines, and more so the LTV to be ensured during the entire tenure of the loan. Some regulated entities were required to maintain LTV at the origination of the loan, whereas banks were to do it during the entire tenure of the loan. Now, this has been harmonized. So from that point of view, it is actually beneficial for banks. That's one.
Correct.
Please
go ahead, sir.
Yeah, the second part is that it is regarding the, they have classified this into two categories, consumption purposes and for income generating purposes. And if you ask me, this is actually a very, very positive step initiated by the regulator, mainly because the industry should be encouraged, the sector should be encouraged to take loans for productive income generating purposes. And over here, they widened the scope. Earlier, it was supposed to be given for farm credit and largely agricultural loans. Now, the scope has been widened for any kind of an activity which is income generating in nature. So this has been where LTV rules will not apply. So, except for NBFC, it's been capped at 75%, but banks don't have this cap as long as the assessment and the repaying capacity is done in a proper manner.
Right. No, that's very, very well explained, Mr. Dugar. Good morning. Prashant here.
Hi, Prashant.
Actually, the sense that this is, of course, all sort of informal, but the indication that we got, actually, a reporter got, was that when this was put out, right? I mean, and if you look at the market reaction, the largest gold loan company, Muthoot, the stock sold off very aggressively. So, but as you said, I mean, and you were also in a state where, I mean, you're based out of a state where gold loans are a big thing, and you know that business, just like Muthoot does or others do, right? Who are based out of Kerala, who've been doing this for many, many decades now. But the sense we got is this is actually more aimed at not the specialized players in this space. It's actually based, these are directed towards banks, actually, who've grown their gold loan portfolios in a very aggressive way. The net impact, as you describe it, may well play out. But do you think that makes sense, logical sense? I thought so.
Prashant, if you ask me, any sharp growth in any sector or by any bank is something which people tend to, and we in the bank also tend to look at it so that there are no hidden skeletons or issues later on which we may face. Now, the good part over here is that gold, while it's a very safe business, it's an operationally intensive business. That's number one. Number two, if malpractices are there or lack of transparency is there, it comes at the cost of the consumer or the borrower, who are typically, like I said, the ones who do not really have access to formal bank finance. So it is essential that these kind of guidelines are standardized, so there is no scope for interpretation or implementation of these guidelines. And that's a very key thing. So that's what the draft circular does. It kind of, like to give an example, the valuation of gold, it's very clearly identified it has to be a 22 carat. It has to be 30 days average or the last day's price, whichever is lower. It's very clear about it. Or where can you take the price from the IBGA or the commodity exchange? So the standardization and uniformity which comes across for the sector is actually, if you ask me, quite a welcome move. The problem is not about guidelines being stringent. The issue is about it being uniform, both in terms of understanding, application, and interpretation. And if that is done, it gives a level playing field to all the players and the people who can have good processes in place and do this in a manner, it's going to be beneficial for them. And that's the reason why we as a bank are quite welcoming.
No, absolutely. That was an important clarification point, Mr. Dugar, that you made, that the LTV norm will be applicable not just at the time of origination of the loan, but throughout the life cycle of the loan. So that perhaps kind of, reins in any kind of excesses that get built in as gold prices fluctuate. So taking forward what you said, give us some sense, say for Federal Bank, out of your total book, how much is gold loans now as a percentage? And in terms of market share, are you confident of winning over market share from some of the NBFCs now that these the rules will be absolutely uniform and harmonious across both banks and NBFCs?
Okay, so to your first part, our share in gold as a part of our total advances is about 12 to 13%. And that's where we are at, largely in the last few years. We are quite bullish on this business because we do feel we have a reasonably good understanding. What we are looking at it in terms of these rules coming in, which is something which is being talked about since the last time RBI came on 30th September, that a harmonized set of rules and regulations will actually be beneficial for all the players. And the players who have strengths in that will actually leverage. To answer your question, will we gain share? Most certainly would like to gain share, not just in gold business, but in all other businesses of ours as well. But gold in particular, we do feel that we have a strong edge. Our understanding is reasonably deep. We have a reasonably good branch presence, and we have a strong customer base. So, basis all these things, I think it's a positive for the bank.
Okay. All right, Mr. Dugar, we'll leave it on that note. Thank you very much. Very helpful conversation. Didn't speak too much about the quarterly update, but we'll talk more about earnings and all the usual ratios, I think, once the official numbers are out at the end of Q4. Thank you.
Thank you so much.
We look forward to that as well. Thank you. Thank you very much for that. Quick break right now. We will come back on the other side with more corporate conversations. And also, we'll put the spotlight on the macros, the impact of Trump tariffs on India. Tanvi Gupta of UBS joins in.
Welcome back. Let's talk about Trump tariffs and the implications for markets around the world. And we have Tanvi Gupta Jain, Chief India Economist at UBS Securities, now joining in to help us with this. Tanvi, good morning. Good to have you with us back on the program. Prashant here. Market odds for a US recession are still around 50%. So it's like a coin toss. What is your global team at? Where is your global team at in terms of assessing the risks? And what then are implications for EMs and specifically India?
Thanks, Prashant. Thank you for having me on the show. So clearly, I think the global uncertainties have increased manifold since President Trump has announced substantial widespread tariffs, including India. So we are seeing 50 to 100 basis point downside on our global GDP growth forecast. Specifically coming to US alone, if I look at the forecast for US, our US economics team has downgraded its GDP growth projections from 1.6%, this is Q4 on Q4, to 0.4% for 2025. If I look at in terms of annual GDP numbers, our US team is now projecting the real GDP growth to slow from 2.8% in 2024 on year-on-year basis to 1.5% in 2025 and further to 0.8% in 2026. So we are still seeing a substantial slowdown, not a recession yet. If I look at China, which is one of the most important countries when I'm looking at EM and definitely for its impact on the emerging market economies, including India, we did lower China's GDP growth forecast to 3.4% today morning for 2025. So clearly, I would say that we are seeing substantial widespread tariff, and this is going to have a substantial impact on the global GDP growth. So when I come back and look at where is India, I think the economic impact will depend on whether these tariffs, how long these tariffs are put in place and whether they are reduced through negotiations. So I would say there are a lot of margins of adjustment that matter, including retaliation, which we are seeing for countries including China, the margin and the FX adjustment and the elasticities of demand. For India, we did reduce our growth forecast for FY26 to 6%. We were earlier at 6.3%, and our 6.3% forecast were already building in 25 to 30 basis point downside of the tariff hike, which we were already pricing in. So clearly, we would say that the substantial impact of the global tariff is definitely being seen in a much slower growth in India. And not only that, I would say within EM, I would say India looks like will be one of the least impacted countries just because we are a more closed economy and a less open economy, but we are not immune.
Okay. Tanvi, so hi, thank you for joining in. Great to have you on the program. So, the range has been around 30 to 60 basis points of an impact on India, and you were outlining some of your estimates as well. Within some of the larger exporting sectors, do you see any, any bigger hit at this point in time, whether we talk about pharma? The thing is, we don't even have firm final numbers for sectors like pharma or even some of the other plays as of now.
If I look at sectoral breakup, I definitely see that there's a lot of room for negotiations. I mean, the bilateral trade agreement talks are already on, but the sectors where we can see a hit and where the negotiations could also take up strongly are agriculture, electronics, automobile, energy, textiles, and alcohol. And these actually account for 50% share of India's exports to the US. I would also say that at this point, India can definitely increase goods imported from the US, including defense and energy. I mean, the biggest and the easiest part that India could do in the interim by the time bilateral trade agreement comes into force is to start substituting, the demand of oil, which we are already coming from Russia, maybe some part from US, and that can clearly reduce the trade surplus, which India has of $46 billion significantly over the coming months. So clearly, I would say the sectors which are going to take impact are the export-driven sectors. But more than that, which I think when you look at U.S. trade tariff and its impact on India, it's not only the slower global growth or the bilateral tariff. I think the biggest uncertainty or the numbers where I see downside is that there could be a postponement of India's private corporate capex recovery due to the risk of China offloading excess capacity to other countries. And that is the biggest concern which I will have, that the investment cycle recovery may get further delayed. From an India standpoint.
Indeed, Tanvi, that's the risk, right? Private sector capex not picking up as much as expected. Got that. But, one positive from this entire tariff tantrum that we've seen from Trump is that crude oil prices have cooled off, which from an India market perspective, it's obviously a positive. And I was listening to the RBI governor last week. He was sounding more growth-oriented. Given that sort of a backdrop, what are you all factoring in from the RBI for the remainder of this year? We've already got a couple of rate cuts. Have you all upped that estimate?
Sure. So if you look at, I think the biggest silver lining, as you rightly pointed, is that oil prices could remain lower for longer. We have taken now $65 a barrel in our growth forecast versus $75 a barrel, which we were pricing earlier before this tariff talk started. Clearly, India is still importing 87% of the oil requirement. So any lower global oil prices definitely bodes well for our economic growth prospects. And that is marginally is an offset when I look at my 6% GDP growth numbers. So the downside could have been much larger, but there is an offset because of lower global oil prices. We definitely think that there is additional policy support needed to sustain domestic growth momentum. And looking at that, the fiscal space is quite limited, and the government already came out with a fiscal consolidation rate part. But I think where we could see some kind of fiscal buffer helping to sustain domestic growth is lowering of retail prices of gasoline and diesel in case lower global oil prices sustain. I mean, clearly a $10 a barrel decline in oil prices, if it's sustaining, can give you a room of at least ₹5 a liter cut in gasoline and diesel prices over the course of the year. Coming back on the monetary policy, I maintain our view that monetary policy will do the heavy lifting to support economic momentum in this downturn. We were earlier building in 75 basis point of rate cut, and now we have revised it and calling for a 125 basis point easing in this cycle, which means that out of 50 basis point, which has already happened, we are building in additional 75 basis point of rate cut, which will bring down the repo rate to 5.2% by end of FY26.
Got that. Tanvi, have you looked at sector by sector that point that you made that private sector capex may take a hit because China has so much excess capacity to sell? Because of that, which sectors could be at risk, and you think we will need to enact, like we've done in steel, anti-dumping sort of measures for a variety of sectors? Do we largely have that protection? What's your sense?
Okay, so first of all, when I look at the sectors, definitely I would expect some safeguard duties by the government to protect the domestic industries. But I think in a globalized world, it is very difficult to control beyond a point. So even though safeguard duties can be put in place to ensure that excess dumping could be avoided, but in the end of the day, if there is so much elevated global uncertainty and if there is a private corporate player, they will think twice before investing. So clearly, I mean, safeguard duties can help a bit, but whether it can substantially change a private corporate capex incentive to invest, I think I've found it very difficult. In this entire mayhem, I think the sector that should do well when I look at India's growth from a broad macro perspective and looking at consumption, investment, and exports, I seriously think that the household consumption could remain largely supportive. I mean, it is largely domestic demand driven. We are already seeing cyclical rural demand is recovering on good crop prospects. So far, the weather agencies are talking about normal monsoons for 2025 as well. Urban demand, at least the lead indicators are showing some stabilization, largely on softening inflation and prospective rate cuts. So I would say, so I think if the investment is going to see more postponement, and we do see that the goods export could take a meaningful hit due to slower global growth, the sector of the economy that should held up is basically and largely household consumption, which is a significant portion of India's overall economic growth.
Okay, all right. Thank you very much for that, Tanvi. Thanks for weighing in and giving us some sense of the implication that these US tariffs could mean for India. So that's the view coming in from UBS. Back to the market for now. Let's take a look at what the screen is telling us. We've still got, this nice 500-point kind of a move. So it's a steady morning so far. Look at that. Rock solid and steady as of now. It's a good-looking screen. We're putting the spotlight again on the auto space because autos are supercharged, turbocharged, so to speak. A lot of those stocks, including, let's actually check out Samvardhana and Tata Motors, etc. Samvardhana is up about 7%. Sona BLW is up about 7.5%. And Tata Motors from the large cap space is also up 4 to 4.5%. Let's quickly I think we've got Sudarshan back with us to revisit why specifically these two. I think, do we have Sud?
Yeah. So
go on, Sud.
So auto is the biggest outperforming sector in the first hour of today's trade, and the reason is over the weekend, US President Donald Trump has announced that he might consider modifying 25% tariffs that US government had announced on autos and auto parts effective April 3, and especially for the imports that US companies do from Mexico and Canada. Now, the question here would be, like, will he consider modifying tariffs only on the imports from Mexico or Canada, or also it would be eased for other imports from UK and from other countries as well? But talking especially about Samvardhana Motherson and Sona BLW, for Samvardhana Motherson, Mexico forms nearly 4% to its total revenue, and for Sona BLW, total contribution is in the range of 2 to 3%. From Mexico, that Mexico production, in the US, the vehicles that are sold in the US, the contribution is somewhere in the range of 30 to 60%. For GM and Toyota, General Motors and Toyota, that contribution is in the range of 30 to 40%, while it's the highest for Volkswagen, which is 60%. And why for Samvardhana Motherson it's positive? Because it's one of the biggest suppliers to these companies in the US, and that's the reason you are seeing big move in all the auto names, and especially in these two counters.
All right, Sudarshan, thanks very much. Got that. Let's actually take this discussion forward with Hemal Thakkar, who is a senior practice leader and director at Crystal Intelligence. He's with us on the show. Hemal, thank you very much for joining in. So from a market perspective, there's a big relief rally playing out on all kinds of stocks. OEM, exporters like Tata Motors, which obviously see US as a big market, as well as the ancillary companies. What did you make? I mean, right now we're only guessing, right, till there's a formal order. What did you make of President Trump's statement that I think the auto companies need more time till they can make here, as in make in the US?
Yeah, of course, auto companies will need more time till the time they make in the US. And US has been largely dependent on Canada and Mexico, which are its neighbors, and other countries, from an import perspective, including the likes of India and China. If you look at it from India's perspective, almost 30% of India's exports are to US. So to that extent, it may get vulnerable. But I don't think, supply chains can be built overnight. It'll take time. This is more of a structural shift, even if it has to take place. So at this point of time, I say we'll be on level playing field, and we may possibly not see much of an impact, in our exports to US, at least in the near term, is the sense that we are able to.
Okay. So, this relief rally that we're seeing within stocks, is it well placed? Because again, in all the tweets, he also reiterates that eventually it all has to be made in America. But obviously, I think he's also finally realizing that supply chains don't move overnight. So do you see the Indian auto ancillary space remaining fairly insulated, considering the on-ground realities?
Yes, at this point of time, structurally, it seems that we are going to be fairly insulated. I don't see much of an issue. I would see US continue as one of the largest market for us as such. And, the exports will not get impacted to a great extent. Because if you also look at, the statements that the President Trump has been making, it seems that India may possibly stand at an advantage as compared to the other peers, barring, the likes of Mexico and Canada, for that matter. So India may stand to gain. And also, if you see in the last 3 to 4 years, we have had significant increase in share to, US as compared to what it is today. So from that perspective, it's going to be a positive to India. And also, if you ask me, the cost and the quality, combination that India can provide to US at this point of time, which is very much acceptable by most of the large OEMs there, is something which may not be, some a competition from other markets as such. So I think India will definitely stand to gain from that perspective.
Hemal, what is the risk to this view? What's the argument if we can approach it from the other side?
What is the risk to the? Sorry,
what is the risk to this view that India largely benefits? Go on.
So as Surbi said, supply chains, if they get rewired overnight, or if there are tariffs which are relatively lower on China as compared to what it is for India, then, you may see India being at a risk. But till the time we are better off as compared to, our counterpart, I think we are, in a much better position, because the only option that US at this point of time would have apart from India would be Mexico and Canada for that matter, apart from China. And if Mexico and Canada are also at a level playing field or a little better than us, but still the kind of volumes that they need, they will definitely need India to support the auto OEM industry that is there in US.
Hemal, just a very general question. I don't know if there can be a clear answer to this or not, but assuming that some level of tariff will eventually come in, maybe not right now, maybe 2-3 months later, whether it's 15% additional tariff or 20% additional tariff. I mean, India's original number was 26%. So let's see, 15-20%. Maybe if that does become a reality, do auto suppliers and component suppliers, do they have enough margin cushion to digest some of it? Or will all of it have to be literally passed on to the end consumer, and then we deal with demand fallout as it happens?
Yeah, both could happen, Surbi. I'm not trying to give you a politically correct answer, but today most of the auto component companies are having margins in the range of about 10 to 16%, depending, on the segment to which they are catering. So the EBITDA margins are in that range. So from that perspective, they will definitely have some cushion, wherein they could absorb a little bit of increase and pass on the remaining to keep the demand active. But as I said, what I still believe, or what Crystal still believes, is that, we are in a much better position when we look at our counterparts. So what sense we are getting is, we'll probably be levied relatively lower tariff as compared to, the strongest competitor that we have will be in the name of China. So from that perspective, if we are relatively better positioned, I think we should be in a position to pass on the, kind of increase that we have because of duties, and should be in a position to protect our margins.
So since you're saying that the only real threat is from China, and going by nomenclature and the language of the social media posts, where President Trump is calling China the biggest abuser, I guess we're okay. We're in an okay space. But let's see. This is a fluid situation. Yes. Every day you wake up to something new. But thank you for weighing in on the situation as it stands today, that perhaps Indian auto component companies don't have too much to worry about at this point in time. Thank you for that. That's a crystal view. Coming in back to the market, like I said, markets were in cruise control mode, 500 points higher on the Nifty. So I think we've got Mitesh. We've got Mitesh back with us. Mitesh, it's a full green screen. So the gap up has happened. Now what? What should the trades be?
Yeah. So there's no sign of worry as well. So I think I would still maintain that we will possibly go higher. We talked about 23,350, 400 as the target. We got a high of 23,368. And despite the fact that we have dropped about 50 odd points, the structure and the position on the intraday hourly, 2-hourly chart still looks positive. So we can look at 23,600 and then 23,750 as the next target zones. Maintain a long bias. And on the stock side, REC is something which is on the buy list. Keep a stop below levels of 407, 408 here, and look for target of 430 to begin with. And Reliance is also, catching my attention. It's open with a gap up, and then while it's come off slightly of the day's high, but the gap is being sustained. Buy here with the stop at about 1225 for a target from 1280.
No, got that absolutely. So those are some individual. By the way, 10:1 still in terms of advances to decline at this point in time. A small name, Mitesh, have you looked at this one? Goldium, large volumes and big price move from the low of 250 back at about 350 in 3-4 days.
Yeah, it's, so Prashant, I used to track the stock earlier. It's, I think, into artificial lab-grown diamonds. And the stock had a weekly pivot at around 315, which was the closing in the November 24 month. And then we got a 307 weekly closing low on the 4th of April. While we didn't go below that, I think we immediately recovered, and then the weekly closings have been higher. I think bouncing back from weekly pivot, the intraday charts are good. The first target of 360 has been met. I think once we see a closing about the 365 zone, good chance that the stock will head towards 410 levels.
All right. Fair enough. Mitesh, we'll speak again. Thank you very much for joining us with that perspective. We take a quick break here. Commodities in focus. Manisha is here with us on the other side.
Welcome back. So equities are having a good morning. Let's figure out what's up with the commodity markets. We have Manisha Gupta with the latest. Over to you, Manisha.
Thank you so much for that. So, Rebel, yes, commodities also are having a good morning. Across board, we're looking at gains continuing here. The last week was a stronger one as well. So, I want to talk about the crude oil prices, which also is trading firm off those kind of 4-year lows that we saw in the previous week there. So, the US relaxing tariffs on key trade partners clearly seems to be supporting. The markets have seen 4% of gains for crude prices in last 1 week. It still is down 8% on month, though, but we have seen near-term gains come in for this one. Well, the another important point that the markets are reacting to is the China import numbers for the month of March, where the crude imports have been 5% on a higher side on year-on-year basis. Well, China clearly has been buying from Iran and Russia, as those reports show. The other thing that the markets are reacting to is the OPEC and allies statement, where there is an expectation that you could be looking at demand going slightly lower. Remember, OPEC also is adding more barrels into the market from the month of May to the tune of 411 million barrels per day. That is something that will keep the prices in check. The other thing that the street will watch out for is the US and Iran reconvening to meet this week yet again. Those conversations were left midway in the previous week. So that is something that you could be looking at some headlines coming in from. Saudi Arabia's numbers should be on your screens, because when you look at the production from that major oil producer, that stands at 8.9 million barrels per day for the first quarter of 2025, which is the lowest in last 14 years. So this is the kind of data from Saudi Arabia, from China, which seems to be supporting the crude oil prices right now. But what doesn't really support is the oil demand estimates for 2025. The weakest of them really coming in from Goldman Sachs. 0.3 million barrels of demand growth is what they're anticipating in this year as compared to last year. JP Morgan and UBS are talking about 0.8. Most bullish clearly is OPEC, which expects that there will be an additional demand of 1.3 million barrels per day in 2025. The other thing really is about the price outlook, where, as you can see, in the beginning of this year, most of these banks were talking about 80 and 85, and there was perhaps a 90 on those charts as well. But now we're looking at all of that below 80 and in some senses below 70 as well. Goldman Sachs report that came in yesterday talks about an average $63 a barrel of a price for Brent for this year now. You have 66 and 8 coming in from JP Morgan, UBS and Fitch. Stand chart is still still slightly bullish on crude oil prices. They expect an average of Brent at 77 for this year. But as you can see, rest everybody else talking about below 70. That's an interesting chart on your screens now. And this is something that the Indian markets are now talking about. Last year, in the month of April, the average crude prices were at 89.4. We've seen a sharp decline from that, $20 down really, in April 2025 in sense of prices. There is a conversation, well, we've seen this custom duty movement as well. And most analysts, oil and gas analysts, will tell you that 2 rupees of a cut, if the prices continue to stay below 70, perhaps is a possibility now.
All right, Manisha, thank you very much for that. Absolutely. Oil, very, very sharp decline. Good for a big oil importer like India. Well, we'll take a quick commercial break here. On the other side, it's our special segment. It's the economy. Lata will connect with Shantanu Sengupta of Goldman Sachs, and they discuss the impact of this tariff zigzag back and forth on India and the global economy. Stay tuned.
Welcome to It's the Economy. One of the sharpest cuts to the GDP of Asian countries post the April 2nd reciprocal tariff announcement came from Goldman Sachs. They had brought down Vietnam's GDP by 1.2 percentage points from 6.8 to 5.6. Taiwan's was cut by 1 percentage point. India's GDP was cut by 30 basis points to 6.1%. But now that the tariffs have been paused for 90 days, does Goldman Sachs have a slightly less worrying view of Asian and Indian growth? What are the specific positives, if any, for India from the domestic policy changes like, lower interest rates and easier liquidity? For all questions, India and maybe a bit global, I'm joined by Shantanu Sengupta, Chief Economist of Goldman Sachs in India. Shantanu, good morning. Thank you very much indeed for joining us. Well, any second thoughts on India's GDP forecast? Any upside risk to your number?
Well, we are sticking to 6.1% year over year for both calendar 25 as well as fiscal 26. Look, I mean, the issue is with the uncertainty. It's not just the direct impact of the tariffs, but this flip-flop that you're having multiple times now, not just at a country level, but also at the sector level, makes it fairly uncertain for especially GFCF or investment growth. which is why we are sticking to the number of 6.1% year over year for growth. In terms of upside versus downside, clearly there'll be two other downsides. One from services exports, and we have been very bullish about services exports in India throughout this period, last two or 3 years. But this time round, we think that if US growth is slowing down, and our US economists think that we are getting towards 0.5% year over year, Q4, that is by the Q4 of the calendar year, if you're slowing down that much, then undoubtedly in our mind, services exports is going to be hit. You're going to see IT earnings also coming through and get some guidance on that. Secondly, if oil prices are here, there is good oil price decline and there is not so good oil price decline. If oil prices are declining so much, we also think that remittances will be hit a little bit. But on the offset side, you'll have lower oil price feed through into our oil imports and give us an oil boost through the current account. And secondly, we think that monetary policy now is in an easy path, right? I mean, the governor was very clear also. You've seen the change in stance to accommodate, and therefore we think that 50 basis points of more rate cuts and therefore further upside from monetary policy.
Okay. Yes, sir. I wanted to refer to your, current account deficit paper as well, which you wrote in March. I think you had a full year current account deficit of 1% of GDP for last year. What are you expecting for this year? Do you expect the current account? I think you went with 1% for this year as well.
Yeah, so the current account deficit overall can be 1% of GDP because of offsets that you're seeing a little bit from remittances, as I said, and the services export drag. But the oil price boost that you're seeing will feed through into the domestic economy. We are unsure about what that channel will be ultimately. So there could be two options, right? One, you hike excise duties and you feed this through the fiscal, and the government figures out what to spend this on. Or eventually you could have a direct cut at the pump price level for petrol and diesel, which is a direct boost for the consumer and the overall aggregate economy. Because remember, this kind of a price cut is difficult to save. An income tax cut, you can have some savings going on. But in this one, we think that it'll transmit through the economy faster. So we are unsure about what that path will be, but we are pretty sure that will act as a boost for growth.
For growth. Okay, so are you expecting a downside risk to your inflation forecast? Your inflation forecast is among the lowest, 4%, like the Reserve Bank. Do you think it can be even lower than that if oil price cuts are passed on? And a related question, therefore, almost all of you on the street are expecting that 5.5 will be the end repo rate at the end of probably by August. Do you expect it can go even lower?
So firstly, on inflation, yes, clearly. I mean, the 4% inflation forecast that we have is with pump prices not changing. But if indeed oil price declines are passed through to the consumer, then we would have downside risk to the 4% inflation forecast that we have. Right now, what we have built in is only the second round effect that feeds through from WPI inflation into core goods and so on. But if you have a direct pass-through, we think there's further downside risk to inflation. Now, to your second question, our sense of what the governor said about, he clarified on the accommodative stance, is that the real neutral rate for the RBI is between 1.4 to 1.9. So let's call it like 1.5 to 2%. If inflation is at 4%, then you should be able to get to at least 550.
Okay.
But if you think that your output gaps are widening, which is that you're growing below potential, call it like the middle of the year, then there's a possibility that the RBI goes in for a deeper rate cutting cycle where the neutral, where they go below the real neutral and have real neutral, let's say at 1% or 1.25%. That will give you a deeper rate cut. Our sense is, with so much uncertainty, I mean, for the central bank also, it's difficult to call it out 6 months down. And therefore, they'll probably go towards 550, keep liquidity easy, which we think is the most important thing. I mean, you've seen this market for long enough also, Lata. ultimately for transmission, what matters is liquidity. So if the liquidity is benign, then that will feed through into the domestic economy and provide a boost to growth. We are factoring in about 10 to 20 basis points of growth offset coming in from monetary policy.
No, actually, I pointedly asked the governor this question on whether he would go for a lower real rate and therefore the end repo rate would be a 5/4. Well, he obviously didn't commit himself, but it did look like he was more dovish than the 5.5 would warrant. Shantanu, you began by this entire conversation by saying that your US economists are marking down the growth in that country, and that's why you are expecting perhaps lower services export flows. What exactly is your team speaking about the US economy? Are they expecting a recession? A lot will follow through from that.
No, we are not in the recession camp, particularly because the Trump administration reversed the tariffs. We still think it is very elevated, though, the recession risks. We are at 45% recession risk for the year, which is pretty meaningful. I think there are a few questions that remain. One is, whether the exemptions or the rate reductions that you've had for telecom, semiconductor equipments, will that remain in place? Will Chinese firms be able to reroute exports to the US via other Asian economies? Or is there any hope of an agreement that brings the broad tariff rate back towards more reasonable levels? So right now, even the 10% tariff rate remains. So if you have a little more beneficial or mutually beneficial trade going on, that is when you can pass without slipping directly into a recession. Overall, the economy was pretty healthy on the US side as you entered into the trade war. And therefore, we don't have the recession call yet. We still think that the Fed goes ahead and cuts thrice in the second half of the year. But again, the uncertainty is what is keeping US growth muted and the recession odds fairly high at 45%.
Okay. What's the Goldman Sachs view on the dollar and the rupee? It's very confusing. The dollar's index has now gone below 100. If one looks at it, the whole effort of the Trump administration is to lower the deficits they have with each country. What does all this mean? I mean, has the rupee seen its worst in terms of 87.95? Both a dollar and a rupee view.
So the dollar view is slightly different from what you're going to see on the dollar rupee in our opinion. Okay. One, on the dollar view, the broad dollar view, we think the weaker trend in the dollar continues. Firstly, there's this combination of unnecessary trade war and the uncertainty, which will be impeding business confidence. Yeah. Secondly, you're seeing the trends in the flip-flop from the government side from the US, right? And that sort of eats into the appeal for the safe haven status of the dollar. And therefore, we think that the weak trend in the dollar continues. So for euro dollar, for example, we are looking at anywhere between 115 to 120 by the end of the year. Whereas for the dollar CNY, which is more specifically Asia, if you're really imposing that kind of tariffs, we don't think Asian central banks, particularly China, will have the incentive to let their currencies appreciate meaningfully. You've seen it in the CNY move also in the previous week a little bit. Yes. Therefore, we think that the CNY stays in the 735 kind of zone. Our call is for the dollar rupee to therefore be around 87.5, 88. Look, if you're having an overall, even 10% tariffs and a growth slowdown on account of that, it does not make a lot of sense for your currency to appreciate in that situation. So we think that if flows are to come back in the future, central banks, particularly the RBI, will stand in the way, will try to mop up and rebuild reserves is what our thought process is. So we are looking at 87.88 on the dollar rupee.
Okay. No, I agree. Actually, even today, I'm surprised that the RBI has allowed the rupee to appreciate to about 11.6 versus the CNY. For the longest time, we were closer to 12. So maybe this is a passing phase, and we are going to see the rupee also depreciate, as you say, towards 87.50. The final question, and I'm trying to squeeze in, do you think India has any advantages? I mean, we hear a lot of positive noise that we will replace Chinese exports, especially in iPhones. Do you see India gaining because of the new trade order?
So, firstly, in the short term, we think it's good that there is no retaliation from India. And our understanding is that the US and India are working on a trade deal with the aim of increasing bilateral trade. In fact, the Ministry of Commerce clarified right on the day when the announcements were made that discussions were ongoing between the US and Indian trade teams for a mutually beneficial multi-sectoral bilateral trade. You've already seen oil imports slightly increase. We think that there can be further deals on defense. And once the dust settles, you can have a relook at the new world order, and India can make its place known there. For the interim period, though, we think that uncertainty is what will dominate. That's the point that we are trying to say, that whether the tariff rates are high or low, the fact that it is changing so many times will just lend uncertainty in the minds of anybody who's trying to put up capacity. So even if you want to realign your trade and move into India, you will want the dust or the uncertainty to settle down before you do that. So not in the interim, maybe in the longer term.
Oh yes, there's no doubt that global investment is going to suffer because of the uncertainty. Why would you want to invest anything? But you keep saying when the dust settles. I hope the dust settles. At the moment, there's no such sign. Thank you very much, Shantanu Sengupta, for giving us some understanding of what is several moving pieces. But we are a little wiser after this chat. Thank you very much for joining us. We have to wrap up on Bazaar on that note. It's a good day for the rupee and for equity markets. The action will be taken forward by Chartbusters after the break.